Interest rates. With the Bank of Canada 50 basis point cut in late October and expectations of another cut when the Bank of Canada meets in December, where do we see rates going from here? Well, much of the interest rate decision-making process is determined by the economic environment of the country. So while in the US, the economic picture is very good, unemployment remains low and inflation seems to be maintaining course towards a long-term target rate set by the Federal Reserve, so they have less need to stimulate the economy by lowering rates. In Canada, the picture is less rosy. Unemployment rising, particularly among youth, and inflation notably down from 2023 highs. So here, arguably, the economy could use the boost of lower rates. So this contrast between economic environments of the US and in Canada will mean that interest rate cuts will differ between the two countries. As the graph shows, Canada is likely to see a more aggressive rate cutting cycle with a 50 basis point cut in December, as mentioned, and then consistent 25 basis point cuts every meeting into mid-2025 being predicted. The US, on the other hand, is more likely to take a more measured approach, cutting 25 basis points each meeting until reaching its 3% target at the end of 2025 or early 2026. What this means for Canadians in particular is that we will likely see devaluation of the Canadian dollar compared to the US dollar. And that will be the case until rates are closer to being in lockstep. The good news is that with rate cuts comes relief for many borrowers with variable rate debt or those approaching renewal on mortgages and on term loans. Like most things in economics, data is key, and these projections are based off data from early October, therefore subject to change as new economic data is released. So stay tuned.